Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are back again for another podcast.
Another day, another podcast, as they say in podcast land. Andrew, how have you been?
All going very well, Bills, all going very well.
Good to hear,
What are we talking about today, Billy?
Andrew, this is something that I really enjoy talking about because I think it's something that's just so important.
And so under the radar, right?
Well, interestingly enough, last week's episode, we were talking about something that was really beneficial that is completely under the radar. This is something that is equally as under the radar. But no, essentially what we're talking about is buy-sell agreements between essentially business partners. Yeah. So elaborate on that, Andrew. What is that? I mean, buy-sell, what does that mean? How do we break that down?
I think the easiest way to talk about it is just to use an example, and perfect example is, let's just say you and I, right? Billy and I have a business together. We each have shares in the business, and let's say that something were to happen to either one of us. So let's say something were to touch wood happen to me. If I was to pass away, what would naturally happen is my wife would inherit my shares in the business. My wife has never worked as a financial advisor. She's no interest in finance or anything of the sort, or running a financial planning practice. And so Billy would now be in business with someone who has no interest in the business, doesn't necessarily want to be involved in the business, and Billy would need to buy the shares of the surviving spouse out. Now, depending on what valuation you want to put on the business, that could be an amount of money that, Billy doesn't have. And so it really creates this issue in that, okay, both parties are in agreement of what they want to do.
Yeah.
Billy wants to take over the business. He wants to have the shares in the business. He wants to run operations and, continue working while grieving for me, obviously. And my wife wants to be remunerated for the value of the business and sell out her shares, and not be involved in operations and all of that stuff of running a financial planning business.
So essentially, the surviving business owner wants to continue running the business.
Yeah, and the spouse or the beneficiary wants to
take the money and then find the next husband and move on to the next thing in this instance,
right?
So,
and realize that there's no one better out there.
Nice.
And so therein is the problem. What happens? Yeah. How do you do it? Well, buy-sell agreement.
So buy-sell is the solution. So essentially, I guess there's two components to how this works, but essentially it's trying to solve that problem, and there's two issues associated with it. Firstly, there's the legal aspect saying that I'm going to buy your spouse's shares and she is going to sell.
Correct.
So we need a legal agreement between the parties. We have this in our shareholder agreement, that is going to happen. Okay, tick to the first box. The second box, or the second challenge that we need to sort out, is how is your spouse going to receive that money? So essentially, rather than needing to, find it myself, we have an insurance policy in place that actually covers the cost of the transfer of those shares that are going to happen.
Yeah.
So in that case, we've kind of ticked the box for everybody who's in the equation, who's impacted by this, potential problem. And from a funding mechanism perspective, rather than needing to come up with the money ourselves, we've now
got an insurance policy that
deferred that out to an insurer. Obviously, we're paying the premiums for it, but that's how we solve the problem of needing to find the value of a shareholder's share if the circumstance ever arises that those shares need to be paid out.
Yeah, absolutely. So let's delve into the weeds. Let's take us through, Billy. What's needed to make this happen? There's obviously an agreement that's needed, but how does this play out in the scenario? How does it actually work and what do business owners need to do in order to enact and go through a strategy like this, or put together a buy-sell agreement?
Look, there's a couple of things. I mean, look, with most of the stuff that we talk about, I think it's being aware of a potential issue.
Yeah.
And you're in the thick of it. You're running your business. You're not necessarily thinking about
someone passing away or being disabled.
What if? I mean, look, we're very good in terms of business owners thinking about risk and managing that, but that's usually in the operations of the business and trying to navigate the business around those risks. So I think the first hurdle to jump through is becoming aware that there is a potential problem, that if you are in business with somebody, that could potentially be something that transpires.
Yeah.
So being made aware of that. And I think, other than listening to the 360 Money Matters podcast and getting all of your information and knowledge from us, you're talking about your professional advisors, so your financial advisor, your accountant. If you're in business with somebody, they should be talking about those couple of things with you. So I think there's an awareness piece around that first and foremost. The second hurdle to get through, which isn't necessarily a hurdle, I think it's just more so of a process to go through, is deciding what happens in the event of. Now, that's pretty straightforward because both parties, if there's two or more than two shareholders, everybody wants the same thing, right? So that should be fairly easy to get through. The third part is the definition of what constitutes a trigger event. So in the ones that we've done, there's usually two, although it can go deeper depending on the requirements of the business. So if a business partner dies, that's obviously pretty straightforward. So there's that one. If they're permanently incapacitated, that's another one. The third one that's a little bit more challenging is if they're in ill health and that goes on for an extended period of time, what does that look like? So that's probably just getting some consensus around what that looks like, and then moving that to a legal practitioner in order to put that together. Next step, which is probably the biggest area of contention that we see, is what valuation methodology do you use in order to value the business at some future point in time that everybody agrees to. So that's probably the biggest one that we come up against in terms of the challenge. So finding a few different ways to value the business, and look, most of the time, I guess it's getting an independent valuer in and valuing the business like that. That seems to be the most fairest and equitable way of doing it. But there may be some adjustments that need to happen depending on lending arrangements and what the balance sheet of the business looks like. So I think just being aware of that, and then in terms of the professionals that you've got and who does what, this would be where we, as the financial advisor, who is usually the driving force behind this, we then pull in the accountant and say, okay, based on the work that you know of the business, what you're doing for the business, how would you go about valuing this? What would it look like? Are there any intricate details that need to be reflected in the agreement in order to compensate for, a particular thing that everybody wants to see? And then once we've got that right, we move into the insurance piece.
Yeah. And then the insurance piece is basically, okay, there's a life insurance policy or even a permanent disability policy in order to be able to act as a funding mechanism. Because if, let's say the business is worth $1 million and, there's two joint owners of 50-50 each, well, then someone coming up with $500,000 overnight is a big ask. And for most people, they don't have that amount of money lying around. And so there's an insurance policy there whereby all that you need to fund is the cost of the insurance premiums, which, might be a few hundred to, a couple of $1,000s a year in order to pay out that amount of money and act as a funding mechanism if something were to occur. So in essence, everybody wins. The business partner takes the shares in the business. The surviving beneficiary takes the value of the shares in the business that were forfeited in an insurance policy. And then there's an independent person in the middle that's acting as an independent third party to value the business in the event that something were to occur. And I think that the benefit really in all of this is you're bringing all of those things to the forefront. I mean, when you've already agreed, and there is to some degree some level of contention in how a business is valued, and usually you'll ask, 3 valuers to value a business and you're going to get 3 different valuations. Very rarely does anyone ever come with the exact same number. But when you're agreeing on that methodology, or when you're agreeing on exactly how it's going to be calculated, when there's no emotional involvement, or when there's no emotion, there's no grieving, there's nothing else other than, just making an agreement at that point in time, it makes it so much easier, as opposed to, fortunately, I've never been involved in a transaction like this. In other transactions where someone's passed away, there's so much emotion, there's so much grieving, that trying to make a rational decision that's fair and equitable for all parties is just, it's impossible. Maybe not impossible, but it's so improbable that getting that all upfront and agreed to and done is just, I can't tell you how
challenging it'll be.
Yeah. You consider it, and I, think about it in the sense of, imagine if your partner had just passed away, or your business partner had just passed away. At what point in time do you approach a grieving spouse to say, hey, you're a shareholder in the business. I kind of want to buy those shares off you because, you don't know anything about the business, or haven't operated in this business before. Should we maybe get a valuation? Like, does that happen in 6 months? Does that happen in 12 months? What period of grieving do you allow? When do you broach that conversation? It takes it all off the table, and just means that, hey, we've got an agreement in place. There's an insurance policy that covers it. There's no need to, worry about it, or need to do anything other than just execute what's already on paper. So hugely beneficial.
From a practical sense, how do we fund the premiums? Because, looking at the two of us, there's an age difference. So naturally my premiums are more expensive than yours. So how do we fund that? Because there's a unequal amount that needs to get paid for the insurance.
So did you
premiums.
Say that
You're older than me? That's right. Yeah.
Just clarifying there, because
look, it's hard to tell, right? Now that we've got a 4K camera, and I'm starting to do a bit more regular exercise and looking pretty fit and tight, Andrew. It's
Billy, it's on camera now and it's out to the world, so you can't stop this exercise program you're on. Look, in terms of funding the premiums, it's really an agreement between business partners as to how it's funded. You can either fund it individually out of your own pocket to pay for your own insurance premiums, and that's it. Other business owners will choose to say, you know what, it is what it is. It's an insurance policy that we're all paying for everyone's peace of mind, and so it's going to get funded from the business. Completely up to you as to who funds the insurance premiums, how it's structured, and making sure that you're pulling in the right professionals when you're enacting this strategy is hugely important, because the agreement itself, the funding of insurance premiums, the transfer of assets can trigger potential tax consequences either or at the time of an event happening. And so making sure that you're pulling in the right professionals that have experience in this area to draft it up in the right way and structure it in the right way is hugely important as well.
To talk about the complexity associated with it, and the reason why I think, that needs to be elaborated and expanded on the point that you just made, is let's run a scenario, right? So if we decide to take out that policy, if we decide to enact this today and say, yep, we've recognised, because we spoke to the team at 360 Financial, that we heard on 360 Money Matters podcast, that we are in a position that we need to look at a buy-sell arrangement. So, okay, fast forward, the business is worth $1 million. So your share's worth $500,000, my share's worth $500,000 today. So we go and get an insurance policy for $500,000 each.
Yep.
Great, tick, 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 fantastic. We fast forward 2, 3, 4 years, all of a sudden the business has doubled in value. It's worth $2 million. Your share's worth $1 million, my share's worth $1 million. The underlying insurance policies are only worth $500,000. We've got a big problem on our hands.
Yeah.
What do we do? How do we avoid it? There's a couple of ways, but what's the thinking?
A few different things to think about. One is most business owners will just say, let's overinsure. Yeah. So you overinsure and you make sure that, you're future-proofing the fact that this is, and most business owners are really good at projecting, hey, this is where we expect the business to get to in 1, 2, 3, 4, 5 years' time. And so you want to make sure that you've got an insurance policy that, covers future growth aspirations or the likelihood of future growth in the business. The other consideration within that, when you're also, making that decision, is just because you're able to get insurance today does not mean that you'll be able to get insurance at a future point in time. And so the earlier that you start on this, so a lot of the times people think, we're all young, Billy's forever 39, Andrew's 31, it's fine. Like, what's the likelihood that someone's going to pass away? We don't necessarily need this until we, maybe get into our 50s or 60s and we're still in business, and then maybe we want to enact a strategy like this. Well, if someone has already had health events, if someone has already had, anything that's happened in their medical history in the past, in order to get an insurance policy, you need to go through medical underwriting. So you need to answer a whole bunch of health questions. And that may result in either not being able to get insurance or exclusions on policies or whatnot. And then there's a difficult conversation of, okay, well, if Billy's not insured, should I be insured? Because there's a funding mechanism on one side, but not on the other side. It creates a very difficult dynamic. And so, number one, getting it done as early as possible means that you're, potentially avoiding that issue. And number two, things can happen at any stage in life. And so it's really important that regardless of, where you're at, if there's a business, if there's two separate business partners, if there's not going to be a funding mechanism, that you're getting this stuff done as early as possible, and reviewing it on a regular basis as well. Because some businesses go, they 10x in a couple of years. And so making sure that, all of your policies are still up to date and all of your agreements are still up to date with all of this is hugely important.
Yeah, and I think that's the critical word that you said in there, Andrew, is you review it. Because things change, and working with a professional, that will happen automatically as part of the review process that we've got. Just to go back a step, on the insurance policies that we recommend when we're going through this, is there's certain options that you can purchase as part of the insurance policy that allows you to increase, and you pay a premium for it, but it's an additional option that allows you to increase the benefit amount of the policy without needing to go through medical underwriting again. You go through financial underwriting, which is the underwriter making sure that your business has increased in value, but that's specifically available for this scenario. So there are mechanisms in place to do that, which is good. But just going back around the importance of this is something that benefits your business, benefits your business partners, it benefits your spouse and your business partner's spouses, right? Think about that scenario that we spoke about before with the business being worth $1 million and then $500,000 each. If we didn't have that in place and something happened, just think about the ramifications of things that would need to occur. If, using that example before, I'd need to come up with $500,000 when I'm trying to figure out, how do I close the gap on, losing my business partner? Your spouse is grieving. I've got an issue with money because I need to find $500,000. Your spouse wants that money as quickly as possible because she wants to move on and find her next husband. What do we do? Like in that instance, we sell half of the business to release that value? That becomes an issue within itself. So very, very quickly, this thing can spiral out of control and just turn into a big pile of mud.
Yeah. And then the other difficulty is, okay, well, what happens if you don't pay the surviving beneficiary out? Now your business is worth $1 million in that scenario, let's say, and you say, you know what, they're going to retain 50% of the business. I'll still retain 50% of the business. They're not working in it. I'm working full time. I'm the driving force behind the business. Now all of a sudden, we fast forward 5-10 years and that business has gone from $1 million to a $5 million business. They're entitled to $2.5 million now. Yep. You being able to pay them out is, as you grow the business and as you do more, you're increasing the gap as to being able to, pay out that surviving beneficiary. And so
the problem gets worse and worse.
Yeah, it's
or bigger and bigger.
It's something that's really difficult unless you've done some proper planning, which really begs the question, Bills. I mean, why do people not do something like this? Why is this not a requirement for people to do when you're going in business with two separate people? Like, what prohibits, or what's some of the limitations of this that prohibits people from doing it?
Look, I think firstly, like I said earlier, it's just an awareness piece. Because most people, if you put this in front of, would go, I see the value in this. Obviously, it's going to cost more because I need to incur that expense for advice fees, for the solicitor, maybe for the accountant, and for the insurance premiums. But for a lot of business owners, you're talking about not only protecting your most important asset, but you're talking about protecting your most important people. So I think if people were aware of it, it'd be an absolute no-brainer. So I think that's probably the biggest barrier to all of this.
Same as last week's episode.
So yeah, I think, that's the reason why we're doing, podcasts and stuff on LinkedIn and trying to get the word out there, because, we can help out. And that's, that's what we do. We are aware of and recognize things that people may not necessarily know that they need. We have seen and can foresee potential issues down the track and work towards highlighting those and doing something about them. So yeah, I think that's probably the biggest thing from my perspective, because the cost associated with the value that you receive and the peace of mind that you get, it's not even a consideration. So I don't think it's a cost thing. Probably the only other complexity associated with it is just the need to go through underwriting when you apply for insurance. So that can be, depending on your health circumstances, that can be quite an onerous process, and it's a bit of a pain in the neck. Depending on the types of level of cover that you need, if it's a significant amount, obviously they make you jump through a lot more hoops as well too. Could be business valuations involved that you need to submit financials to the insurer. If the benefit amount is high enough, you may need to do some medical testing. So a whole range of different stuff. But coming back to it, I think that's a really a drop in the ocean in terms of what you're asked to do based on what it is that you get in return.
Yeah, absolutely. Bills, very well summarized. And again, if you do have a business, if you've got a business partner, I think it's massively important to really consider a buy-sell agreement, at least have a conversation with a professional around, what's entailed and what can be of benefit. Because once we run through it with clients, I think it's never a question of, is this worthwhile going down? It's just how quickly can we execute it?
Yeah, or if you know somebody that has a business with somebody, it's usually quite common in family businesses as well too, where there's multiple parties and stuff like that. But always happy to have a chat to people and talk through their options.
Absolutely. Bills,
Andrew,
thank you very much. It was another great podcast, another whole heap of value. Hope all of our listeners and our viewers got a bit of value out of that one. And if you have, like, subscribe, and look forward to catching you on the next one.
Thanks.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of AMP Financial Planning.